Hi everyone, thank you for joining us today. I'm super pumped about this webinar. A, because there's been so much interest in it, and B, because it's kind of back to basics, which is a little bit kind of back to my roots. We're going to go over basically 4 things today. 1, what is an HSA? 2, generally speaking, lightly what's covered and some fun things that are covered. Some opportunities, and we've identified 3 that we see every day. So hopefully you can take these opportunities away with you, and you might start to see them pop up in your region or with your clients that you see every day. And then finally, we're just going to address a few of the most common questions. So we get asked these all the time, especially with advisors that are new to selling HSAs. And then that's it. We'll wrap it up, and then you can follow up, and we'll do a Q&A at the end of the call, like always. And you can just put your questions into the chat feature that you see with Join Me. So what is an HSA? So these have actually been around since 1989. And when Paul Martin was the finance minister, that's when they introduced the concept of HSAs, or what they're most commonly called in the Income Tax Act is PHSPs. Now, throughout the years, these things have gotten all sorts of different names attached to them, which is a little bit of the bane of our existence, because we constantly have to educate people that this acronym is the same thing as a PHSP, and even ourselves, we call them an HSA. But some of the common terms that you'll hear out there is healthcare spending account. So that's typically the insurance companies like to call it that. Cost plus is used interchangeably with an HSA, but in fact a cost plus arrangement is very different than an actual PHSP arrangement. And in the Income Tax Act that talks about PHSP, it actually defines exactly what a cost plus is. And just so we're super clear, we always try and be very, very clear with this. We do not operate a cost plus, nor do we even ever want to operate a cost plus. Health trust, so there's health and welfare trust, health trust, that name floats around there. Not so much anymore, especially since February of last year. No one is allowed to offer a health and welfare trust any longer, so there can't be a new health and welfare trust established after February 2018, and that was announced in last year's budget with the Liberal government. And then as well, spending accounts. So we do like the term spending accounts because for companies like us that do offer a taxable wellness account, you can have that type of taxable account, and then a non-taxable would be an HSA or PHSP. So those are just some of the names that you'll see out there. How does it work? So when I originally left my position in financial accounting to join up with Tim Kane and what was called BKI Financial, I immediately fell in love with this HSA concept. I didn't know much about it, and being a little bit more comfortable with the tax and accounting side of the business, I just dove right into it. And they're amazing. I've always thought they were amazing, and even when I went out to sell it, I always talked about them because I think conceptually they're great. So what are they? So basically, CRA has set out a list of eligible items that basically include medical, dental, and vision expense items, and they allow companies to set up a PHSP or HSA and give an employee of the company a flat dollar amount, and then the employee can use that dollar amount on anything eligible under the HSA or CRA's eligible item list. Then when those funds are actually used, the corporation can write off 100% of the costs related to that health spending account, and the employee receives the benefits tax-free. So what is covered? This is a very, very exhaustive list, and the cool thing, what we did, is basically take the list that CRA has and put it into our apps and our online claiming system. So anything and everything that's eligible under the list, you will find in our claims process. We also built in a feature where you can actually search the list because, again, it's a very exhaustive list. So you can search to see what's covered. As well, too, what we put into the employee's dashboard is a little bit of a working document, if you will, where they can actually pick and choose under certain categories what's eligible. So like extended health care or health-related things, what's eligible under there, dental, vision, etc. And so what CRA has done is basically said, you're allowed to structure an HSA, and we're going to piggyback off what the allowable expense item list is through the income tax folio that's related to the medical expense tax credit. So that medical expense tax credit is something that individuals can claim under, and CRA just basically, to keep things simple, which I think is smart, just said whatever that list says, we'll follow. And again, there's a lot of things that aren't covered under a traditional insured plan that can be included in this. So that's where a lot of people find the flexibility useful. So they can basically cover things that aren't traditionally covered under a group insured plan. So some of those unique things. So first and foremost, the number one thing we talk about is orthodontics. So typically, orthodontics will be cut out of a traditional insured plan, basically just because it costs a lot to add that because it's such an expensive procedure. And then it will also include orthodontics for only children. The other thing that we see used all the time, with, especially in our HSAs, because again, we feel and we work only with employee benefit advisors, so we like the idea of an underlying insured plan to some level. It might be more traditional insurance as the group is larger and then an HSA layered on top of it. Or if it's smaller, then it's more of a heavy self-insured HSA component. But things like copays. So even if you've got a class of executives and you've got an underlying traditional insured plan that, say, pays out at 80% drugs, that 20% that the traditional insurance doesn't cover, you could run through the HSA so that that class of employees is getting reimbursed 100%. Another one is laser eye surgery. So that's fully eligible under an HSA. And one that's especially come up in the last 2 years, as you can imagine, is medical cannabis. So medicinal marijuana has been eligible under an HSA for years. And we've been processing claims for that for years with that. And you're seeing a lot more and more conversations, especially with the companies, on as to what they can either do, so add the coverage to their group benefit plan, the medical cannabis, or if the employer feels strongly that they don't want it included, how do they carve it out? So we can actually have the ability to keep it under the list, or with My Define, we can actually exclude specific things like medical cannabis from a HSA eligible item list. So those are some fun ones that are unique. Again, the list is super exhaustive. We'd be more than happy to chat with anyone about certain things that are covered. We definitely know the list inside and out. And like I said, it's fully available on our app and online. So some opportunities. We see 3 opportunities. And the first one is the simplest one. And this is what, when I was a group benefits advisor and I was working alongside P&C brokers, my mandate was every meeting I went to try and sell benefits, RSPs, or some life and accident insurance, was to leave the meeting with the business owner and have an HSA. So, and I don't think it's changed ever since. These things are a no-brainer for owner and operators. So regardless of the size of the business, every business owner who has an incorporated operating company should have one of these set up. And the reason being is that, so A, especially with our offering, is it's free to set up. So it doesn't cost anything to set up. They don't need to pre-fund it. So they don't need to, say, set up a executive plan and pre-fund, say, $15,000, we can do pay-as-you-go. So it's just sitting there set up and ready when and if anyone in the executive's family runs into health, dental, vision costs. And so my argument always was every family pays these every year, so health, dental, and vision. And most likely they're not even taking the personal medical exempt tax credit. And this is much more advantageous because the company gets 100% of the write-off, so there's no income level testing. They get 100% of the write-off, and then the executive gets reimbursed tax-free. So essentially, they're pulling corporate money out of the corporation, taking it personally, tax-free, all under the structure of a health spending account. So I used to say, you know you're going to have these expenses. Let's just set this up right now. It's free. And then when and if you need it, we can go through and help you process claims, so to actually submit the claims. Then even as well, if they do have employees below them under a traditional insured plan, so they probably will have some sort of basic insured plan, any of those co-pays or anything that the executive wants to be put through and ran through the company will go above and beyond the traditional insurance. And they don't have to set up an HSA for all employees. Just like group benefits, you can have classes of employees, and all classes of employees don't necessarily need to get the same benefit. So you could have an executive that gets a higher amount or an HSA only, where all of the employees, part of their compensation might not include the HSA component. That's perfectly fine, and CRA actually sets out 4 questions to ask when you're wondering if you can have a shareholders class that has the benefit. So it's all laid out. It's nothing to be scared of. There are 4 basic questions. The second opportunity we run into all the time is incorporated businesses with employees. So this is when you start to get into larger employees. Typically we find 1 employee to say 50 employees. And here you're starting to have the conversation about, should I self-insure and just have an HSA? Or should I do a traditional insurance plan where there's a component of insurance as well as a spending account? And so we think it's a fantastic place to be in as an advisor, and there's huge opportunities here because we believe in insurance. So there's certain, especially the pooled insured products, you definitely want those in place. They're good for the employees. They're good retention and attraction tools. And you can kind of find solutions for small to mid-sized groups in that space. But then you can come down to the extended healthcare dental vision portion. Some of that can totally be insured. So something like a drug-only plan where there's unlimited drug coverage, that might be something that they want to insure. And then all of the other things, they can pick and choose what they want to insure. So, you know, a lot of times, for example, vision, not everyone needs glasses. So why would you basically put a coverage in place that all employees have to get, but only a few can use it? Where you could put in a spending account where you can give it to all employees and make it flexible. So those who have glasses, they can use it for that. But then the other people who don't have glasses, you're not necessarily hurting them by giving the benefit. They can use it on something else like orthodontics or massage therapy, whatever. You can pick and choose what they can spend it on. So you can carve out certain aspects of a traditional insured plan and put in a self-insured plan through an HSA. Then you can extend that out. So maybe you want to, and as an advisor, you look at the dental program. Maybe you want to start to look at self-insuring that component. Or even things like you might have an insured basic dental program, but you want to extend some coverage for some major items like crowns or orthodontics. So you can top up that part with an HSA. So, and the powerful thing about this is that as an advisor, you can go into that renewal each year or when you're discussing plan designs, and it's a lever So it's kind of like you can choose with the client how much they want to be self-insured, how much traditional insurance makes sense, and you can provide that value and provide solutions on both ends of the spectrum to fit whatever they want to offer their employees. So it's a huge market. Then you start to, so that's just even from an HSA standpoint, but you can also add things like a wellness spending account. So even these companies that have 25 employees, I will bet you that if you walk in and ask if they have a wellness spending account and use the example, do you reimburse some employees for things like gym memberships? They offer it right now. You're just not administering it. We're not administering it. So they're doing it by Excel spreadsheets. And I always like the idea of you don't even need to take that wellness spending account, into your office by using our software, but at least they know you have the option to take that headache, what is probably or could be a headache, and extra admin work off their plate. And for, the going rate of 10% per claim, many employers kind of just say, I'll pay that all day long just to not have to deal with me adjudicating Sally's yoga pass, and I've got to be the bad guy when that's not on our list, but they're trying to convince me that it should be on their list. So we think that's a huge opportunity. Then the other thing is My Flex Plan. So companies that size are limited. They're smaller companies. They don't have access to the big benefit plans that you can get through insurance companies, and they're trying to attract and retain employees. My Flex Plan is beautiful in this market because basically you can give them the option of HSA and a wellness spending account and let the employee decide if they want to spend it on medical related things, so things in the HSA non-taxable side, or if, say, it's a younger demographic, maybe they don't have a family yet, they're super active and they want to stay active and healthy, so maybe they divert some or majority of their funds to wellness things. And again, the wellness side, completely customizable from the advisor or from the company level, so the advisor and the company can decide exactly what's actually on the wellness list, but they have the ability to pick and choose and customize it. So again, you can build a flexible, tailored benefit plan to companies that flat out would never have access to that sort of plan design with a large traditional insurer. And then finally, in the larger group market. So this is a group or an area that, to be honest, has completely surprised us that we're so heavily involved in it, because initially we thought the business was, the sweet spot was those, 1 employees to 200 employees. But what we're starting to do is adding, 1,000-person group, 2,500-person group, and what they're taking advantage of is just the WSA sometimes, just as a standalone, so just utilizing the software to claim wellness-related items. But as well, too, they'll add up as a top-up to their, in many cases, their Cadillac plan that they have from the insurance company. They're looking for a little bit of an edge to give employees, and they love adding the My Flex Plan. So they add the wellness side, so they can customize that list. And again, here you'll see these lists with the larger employer. There'll be 150 items on it. And again, we can build all that. That's okay. We can do that. That's no problem. But then they'll add the HSA component. And the idea here is they want this top-up, this $1,000 top-up to be super powerful, and employees love it, where they can make claims for things that aren't covered in the traditional insured plans. They might use it in that. As well, you get the taxable, the wellness component of it, and then we'll actually see things like RRSP added to it. So where the employees at the beginning of the year can choose HSA, WSA, and even a group RRSP. So they can take this $1,000 top-up and divert it all to the group RRSP to fund for their retirement. So it's a super interesting use of our platform, and we've had tons of success. So just because you're talking to larger companies, don't think that it's not an opportunity for an HSA or even better, a My Flex Plan. because we do have lots of cases on the system that are larger and larger groups. Okay, finally, some common questions. So these are the things that typically when we're sitting down with a new advisor or talking to a new advisor, these always come up, especially the first HSA that they set up. So they see the system, they get excited, they kind of get the concept of it, and now they're out hitting the pavement. Then the business owners go, oh my God, Johnny, like this is fantastic. I just got braces for my daughter last year. Can we backdate it? So backdating is a very common question. And it's a little bit of a, not a tricky one because it makes sense once you hear the idea behind it. And again, we always say, like, especially with backdating and that sort of thing, run it by their accountant first to see what their opinion is, because in the end, their opinion is the one that matters. They'll be the ones defending it with CRA. But here's our thinking with backdating. So from a simplest look at it, you shouldn't be allowed to backdate these plans. Now, their accountants, I'm telling you right now, their accountants will have different views on this, and that's totally fine, and we are open. We talk to accountants all the time, and we're open to giving, our thoughts on it. And again, the final decision lays with them. But backdating to us should not be allowed, and here's why. Because in CRA's documents, a PHSP is a plan of insurance by definition. And as such, in our thinking is that if the expense has already occurred, you can't buy insurance for something that's already occurred. So just the same concept as you've been diagnosed with cancer, you can't go out and then buy a critical illness policy. That breaks the element of risk, and it's not a plan of insurance. So our simplest thinking is that backdating falls under the same guidance. HSA limits. So they'll go to meet a business owner who's also an executive, and they'll kind of say, like, what amount, what's the plan limit? What does CRA say for plan limit? CRA doesn't tell you what limits can be set, just that it needs to be reasonable. And again, this is where we usually tell people 10 to 15% of their income. So not necessarily 100% T4, because how a corporation or how a business pays an executive won't always, and typically isn't always, straight T4 salary. There could be T4 salary, there could be dividends, there could be stock option plans for publicly traded companies, there could be bonuses. What you're looking for here and what CRA actually says in their own documents is that to be reasonable relative to their role in the company. So again, Tim Kaine always references, like, if you were hiring someone for the same position, what would their benefits package look like? And the consensus around the industry is typically that will be 10 to 15% of income. That's a general guide for benefits costs to their income. So that's usually what we say. So 10 to 15% is kind of the rule of thumb. Shareholders. So we get this question all the time as well. Can shareholders have the benefit? It's out there in the industry that shareholders cannot have a benefit, and they always reference this one IT bulletin. But the problem with referencing this IT bulletin is, A, it's just a IT interpretation, so it's not actually law. And the biggest thing in this is it says shareholders cannot have a cost plus. So it references, it's clear as day they can have a cost plus. Now again, remember that a cost plus is open-ended, and it's something completely different than a PHSP. There is a very, very clear outline in CRA that asks those 4 questions. Again, I mentioned it earlier, as to what a shareholder has to ask if they're getting the benefit. So the first and foremost rule with that is, number 1, they can never get the benefit based on their shareholder status, which I agree with. Like we always say, like, think of HSAs in the industry as what they are. They're meant to be an employee benefit. That's the whole reason they were created in the first place, was to give a small company a different option than insurance for employee benefits. Like that's their intent with this. So you can never get the basis that you're getting the benefit based on shareholders, but you can get the benefit based on your role with the company as long, and then right behind that definition is as long as it's reasonable. And again, reasonable is, I know it can be gray, but again, that's where including their tax professionals always smart, and we can show them the exact IT bulletins that lay this all out to help them kind of learn the process. But they can have the benefit as long as it's reasonable and as long as it's based on their role with the company. So they have to be active and it has to be reasonable. So as long as there's a reason why they're getting the amount that they're getting. The third point to that is people will always say, well, the owners or the executives, because there might be multiple owners, the executives want it set up for themselves, but they don't want to offer the HSA to the other employees, so like rank and file employees. We can't do that, can we? You actually can as well too. In that same document that they talk about shareholders, they touch on that. So they say if it's not offered to all employees, there must be a reason that it's not offered. So one could easily argue, and we see this all the time, where the employees have a benefit plan. Sometimes the owners don't even participate in the underlying benefits plan. And then the other thing is that simple traditional insurance plan, that might be totally fair and reasonable as part of their compensation in that industry. And then, but you have a set of executives, and we all know the field, there's executive compensation. Their package in that class of employees might look totally different, and rightfully so, it should. So they might get the traditional underlying insured plan, but topped up with an HSA. So it's totally allowable, and what we say is always just document. Document why you've set it up, and why, if it's not offered to all the other employees in the plan, what's the reasoning behind it? And CRA, they do. They lay it out. Here's what needs to be looked at. They don't give you the answers to the test, which we all know they never will, but they definitely give you the questions that are going to be asked if they go to look at it. So it's nothing to be scared of. They do lay it out nice and cleanly. You incorporate their tax professional, and these things are not scary, and they're fantastic tools that advisors can use. So that's all we had for today. I want to keep it short so that we can kind of hopefully give you as much value in the shortest amount of time, because I realize you all are busy. Thank you so much for joining us, and then we'll jump into the Q&A section right now.